Namaskar and a very good evening to one and all. I, CA Deepak Chopra, Chairman Direct Tax Committee of Karnataka State Chartered Accountant Association, welcome you all to the first part of today's session on tax audits. There haven't been any changes in this year's tax audit report per se. In fact, for the past few years, the various clauses of Form 3CD have remained unchanged and more or less are well settled in our minds. With this in mind, we at KSCAA have taken a conscious call to abstain from a clause-by-clause seminar and instead have decided to spend our energies and times to only absorb the incremental changes in the law and the case laws relevant for this year's tax audit. On amendments pertaining to trust audits, we had a fantastic session by CA Rani NR. Those of you who missed the session may see a recording of the session on YouTube. Please visit and subscribe to KSCA's channel on YouTube. Today, to deliberate on other recent amendments relevant to current year's tax audit, we have with us CA Shri Sudheendra B R. On behalf of entire team KSCA and the participants for today's session, I extend a hearty welcome to you, sir. A quick introduction of sir before we hand over the proceedings to sir. Sir holds a bachelor's degree in commerce and law from Bangalore University and a graduate membership of ICWAI. He qualified as a chartered accountant in 2006 and practiced with Messrs. H.C. Kincha and Company and Messrs. H.C. Kincha and Associates Chartered Accountants till 2017 for 10 years. He enrolled as an advocate in 2017 and is currently practicing as an advocate. His area of expertise is income tax compliance, consultation, and litigation. He has represented many cases before income tax authorities, appellate tribunal, and High Court of Karnataka. He was an income tax teaching faculty at ICI Bangalore branch and contributed lectures as part of e-learning initiative of ICI. He has been teaching income tax to CA Finance students of CAPS for over a decade now. He has spoken at seminars and contributed articles published in ITR, BCAJ, and others. His articles on carry forward and set off of MAT credit under Section 115 JAA, published in October 2009 edition of BCAS Journal, was awarded PM Trivedi Prize for Best Article of the Year 2009-2010. He is part of the team revisiting Sampatanga's commentary on Law of Income Tax 13th edition. With this very brief introduction, I hand over the proceedings to you, sir.
Thank you. Thank you, Deepak. At the outset, I would like to thank the KSCAA for giving me this opportunity to speak about the recent amendments under the Income Tax Act relating to tax audit for assessment year 23-24. Before starting, I would like to make my pranams to all my gurus and begin the discussion. To begin with, we will discuss about Section 14 capital A. To give a brief introduction, Section 14A deals with the disallowance of any expenditure incurred for the purpose of earning an income which does not form part of the total income. This provision is applicable for all 5 heads of income under Chapter 4 of the Income Tax Act. Now, over a period of, starting from its introduction, over a period of years, the legislature has made, the judiciary has made has given various decisions in the context of Section 14A on various aspects of Section 14A. Now, with this, the Finance Act 2022 has done 2 amendments in Section 14A. We need to understand these amendments one by one. Number one, before the amendment, the Section 14A read as for the purposes of computing the total income under this chapter, that is Chapter 4, comprising of salary to other sources. It started with the words for the purposes of. Now, instead of these words, the legislature now has introduced a specific expression, which is notwithstanding anything to the contrary contained in this act. So thereby, the Section 14A has been given a overriding provision, overriding effect over all other contrary provisions contained in the Income Tax Act. That means if any contrary provision is there in under the Income Tax Act, which is directly in conflict with Section 14A, then Section 14A will take the precedence and it will prevail if it conflicts with the other provisions of the Act. This is the amendment done by the Finance Act of 2022 with effect from 1/4/2022. What was the need for this amendment? There was a Delhi High Court decision in the case of PCAT versus Oriental Insurance Company Limited, which said that Section 14A does not apply to an insurance company on account of special provisions which are there in Section 44 of the Income Tax Act, on account of special provisions under Section 44. Because insurance companies, there is a special provision under Section 44 to compute the income. So therefore, the Delhi High Court was of the view that Section 14A will not apply to such insurance companies. Now, in order to overrule that decision, legislature has done this amendment by giving a overriding effect to Section 14A over all other conflicting provisions of the Income Tax Act. Even though it overrides the other provisions, this is limited under Chapter 4. This is the next important principle to be understood. Why? Because it is Section 14A is contained in Chapter 4 of the Income Tax Act, and therefore it does not override the other provisions under other chapters of the Income Tax Act. For the purpose of computation of income under 5 heads of income, yes, we agree that Section 14A will take effect, will be overriding with the other provisions of the Act. However, for the purpose of other chapters, for example, under MAT, while computing the book profit under Section 115 JB, various courts, the special bench of the decision, the special bench of the tribunal in the case of REIT investments, and the Karnataka High Court in the case of various cases, has said that Section 14A cannot be made in the context of the disallowance under Section 14A cannot be made in the context of computation of book profit under Section 115 JB. If there is any book expenditure sitting in the P&L account relating to exempt income under Section 10, yes, the assessing officer is well within his powers to disallow that under Section 115 JB. But as such, Section 14A, Rule 8D, the artificial computation under Rule 8D cannot be mechanically imported for the purpose of computation of book profit under Section 115 JB. Now, coming to the second amendment made in Section 14A, what is this amendment? There is a new explanation at the end of Section 14A, which has been again introduced with effect from 1/4/2022. What does this say? This says that for the removal of doubts, it is hereby clarified that notwithstanding anything to the contrary contained in this Act, the provisions of this section shall apply and shall be deemed to have always applied in a case where the income not forming part of the total income under this Act has not accrued or arisen or has not been received during the previous year relevant to an assessment year. This is one part. Second part is, and the expenditure has been incurred during the said previous year in relation to such income not forming part of the total income. So the new explanation has two parts. The first part says that whether or not you have earned any exempt income, whether or not exempt income has accrued, arisen, or has been received during the previous year, without considering that fact, the provisions of this section shall apply and shall be deemed to have always applied. Second part says that even under this new explanation, there has to be expenditure incurred during the said previous year in relation to such income not forming part of the total income. So the deeming fiction is there. The explanation will be applicable only in respect of an exempt income, whether or not it is received. But nevertheless, expenditure has to be incurred by an assessee in relation to exempt income. Only then the new explanation also will be applicable. In a case where the assessee has not at all earned any expenditure during a particular previous year for the purpose of earning an exempt income, even under the new explanation, the revenue authorities cannot make any ad hoc disallowance or ad hoc disallowance of any expenditure under the new explanation. What was the need for this amendment? Again, various decisions have said that the Section 14A will be applicable only if there is an exempt income during the year under consideration. The Delhi High Court in the case of Keminvest, the Karnataka High Court, various high courts have categorically said that in the absence of any exempt income during a particular previous year, Section 14A cannot be made applicable. Now, this new explanation will apply with effect from 1/4/2022. The explanatory memorandum notes on clauses very categorically states that this new explanation is applicable from assessment year 22-23 and for all subsequent assessment years. A question arises as to, looking at the language of the explanation, can it be interpreted to be retrospective in nature is the question. Because as you would see, the explanation says that for the removal of doubts, the provisions of this section shall apply and shall be deemed to have always applied. So based on this language, can one interpret that Section 14A disallowance can be made even in the absence of exempt income, even for all the earlier years prior to assessment year 22-23 is one issue. Already the Delhi High Court in the case of ERA infrastructure has said that new explanation is always prospective in nature, not retrospective. Now, the usage of the words for the removal of doubts shall be deemed to have always applied. These usage will not make a provision automatically retrospective. This is the position as held by the Supreme Court in the case of SEDCO, Forex International Drill, and Aqua Technologies. So merely the explanation saying that for the removal of doubts, it is always deemed to have applied doesn't mean that the provision is always retrospective. But the principle under the principle of law explained by the Aqua Technologies by the Supreme Court is that has it changed the position of law? If any explanation is generally meant to clarify a particular position, but if an explanation has changed the entire position of law than that prevailing earlier, then explanation has to be given only a prospective effect. Therefore, applying these principles, the Delhi High Court has said that this is a explanation which is applicable only for assessment year 22-23 and subsequent assessment years. Therefore, for our tax audit for year 23-24, this explanation is very much applicable. So we cannot take a view that in the absence of exempt income, we are not going to make any disallowance under section 14A. We have to be mindful of the new explanation, and we have to apply the provisions of new explanation as it is for AY 23-24. Now, what was the need for again this amendment? Because there was already a circular number 5 of 2014 dated 11/2/2014, which said that even in the absence of an exempt income, the disallowance under section 14A has to be made. But even after the circular, even after that particular circular, the various high courts have constantly taken a position that we are not going to follow the circular. Circular is not binding on the High Court or the assessee. Therefore, the High Court had said that in the absence of an exempt income, disallowance under section 14A cannot be made. So in order to overrule these decisions, the new explanation has been introduced to section 14A. Thereby, the circular number 5 of 2014 has been given a statutory effect by introducing explanation to section 14 capital A, and all the other earlier decisions have been overruled by the new explanation. As I said earlier, even under the new explanation, has to be the incurrence of an expenditure. Only if the expenditure is incurred and claimed as deduction, section 14A is applicable. If the expenditure is not at all incurred or incurred but not claimed as a deduction, then the question of invoking section 14A should not apply at all. Rule 8D also, there is a proviso to Rule 8D which says that disallowance shall not exceed the amount claimed by the assessee as a deduction. So all these points to the fact that the expenditure has to be incurred for the purpose of earning an exempt income, and it should have been claimed as deduction. On satisfaction of these two decisions, conditions cumulatively, the disallowance provision under section 14A will apply. Section 14A is not a deeming provision to tax an artificial amount as income. It is not a provision like section 68, 69, 69A, etc. So you cannot simply make an addition under section 14A for the sake of making addition. There has to be a particular expenditure incurred by the assessee, and that expenditure has to be incurred for the purpose of earning the exempt income. Now, 14A subsection 2 gives powers to the assessing officer, wherever an assessee claims that he has not at all incurred any expenditure for the purpose of earning an income, then directly 14A subsection 3 would apply to say that even in such a case where the assessee has claimed that he has not incurred any expenditure, the provisions of section 14A will be applicable. Now, from there, section 14A subsection 2 gives powers to the assessing officer. He has to record his satisfaction regarding the incorrectness of the claim made by the assessee. Incorrectness of the claim made by the assessee having regard to the account. So that means the assessing officer has to go through the accounts of the assessee, and he has to record his satisfaction regarding, and he has to arrive at a satisfaction that yes, the disallowance not made by the assessee is not correct as per law. Then only section 14A gives rise to application of Rule 8D, and the assessing officer is empowered to apply Rule 8D. Now, as I said, section 14A is applicable for the purpose of chapter 4. Now, within chapter 4, we also have various presumptive provisions like section 44 AD, ADA, wherein a presumptive a particular rate of gross receipts is applied to on a turnover or gross receipt, and that particular rate, 6%, 8%, or 50% of the gross receipts is treated as the income under the head business or profession, and corresponding business income is computed under Chapter 4D. So wherever such presumptive provisions are applicable to an assessee, then there is no question of making any disallowance and separately under Section 14A, because whatever is the presumptive income computed, that would be the last figure, that would be the figure of business income which is taxed under Chapter 14A. Chapter 4D, from there from that particular amount, you cannot make any disallowance under Section 14A. This also has to be borne in mind. Now we will move on to the next amendment made by the Finance Act 2022 with regard to the exemption given or the relief given for the amount received by either by the employee or by his family members on account of COVID-19. So the COVID-19 relief amendments have been made by Finance Act 2022 following the press release dated 25/6/2021. That this is the first event which happened on 25/6/2021. Following that, amendment was made by Finance Act 2022 with retrospective effect from 1/4/2020. That is, with effect from 2021, being a beneficial provision, legislature was conscious to make these amendments with a retrospective date from assessment year 2021. Now, these amendments, there are three important amendments which we need to see and understand under this particular aspect. The first amendment dealing with the employer-employee relationship. The first amendment is made under subclause C of clause 2 of first proviso to section 17, subsection 2. Now, under section 15, salary from an employer or a former employer, salary due from an employer or a former employer is chargeable to tax under section 15. Section 17 subsection 1 defines the term salary, which is an inclusive definition. 17 subsection 2 also inclusively define the term perquisite. There are various instances, there are various classification of perquisite under section 17 subsection 2. The first proviso to section 17 subsection 2 deals with cases which are not regarded as a perquisite under 17.2. So the first proviso being an exception, a lot of various perquisites have been listed which are not taxed as perquisite under section 17. Now in clause 2 of the first proviso, which deals with various exceptions, they have made an amendment in clause 2 by adding subclause C. What is this subclause C? It says, provided that nothing in this clause shall apply to any sum paid by the employer in respect of any expenditure actually incurred by the employee on his medical treatment or treatment of any member of his family. Clause C, this is the amendment. In respect of any illness relating to COVID-19, subject to such conditions as the central government may notification in official gazette specify in this behalf. Now, what is this amendment about? This amendment is about any sum received from an employer. So that means the employer has to pay this amount. The question here is whether former employer is also included in this. Now, as we discussed section 15, we understood that salary due from an employer or a former employer is chargeable under section 15. But however, if you see section 17 subsection 2, which deals with definition of perquisite, at various places, consciously the legislature has used employer and former employer separately. So what is the position? Whether former employer is also included here? Two views are possible. If you interpret that former employer is also included here, then whatever amount received by former employer will be included under section 15, correspondingly exempt under this particular exemption. Or if you take a view that no, former employer is not included in this category, only employer is included, then what would happen? This would lead to an absurdity wherein amount received from former employer being a income under the head salary will be included, will be taxed without any perquisite, without any exemption. Correspondingly, under section 56 also, you will not be able to get any exemption. So that would lead to a case wherein exemption will not be available both under section 17(2) proviso because it is received from former employer. Secondly, under section 56, there is no income which is sitting in section 56, so as to claim exemption from 56 to 10. So a safe option, a safe position, I think would be to say that employer should also include a former employer in the context of this particular beneficial COVID-19 relief measure, so that amount received from former employer also would get exempted under section 17. So what does this say? This any amount received from employer is covered in the proviso. There is no maximum limit which is specified in this particular provision. Without any limit, any amount paid by the employer is covered here. The payment can be directly to a hospital, nursing home, etc., which has treated the employee or any of his family members for COVID-19 or any illness related to COVID-19. Or the payment can be in the form of a reimbursement to the employee. Both are covered in this particular provision. So the payment has to be made from the employer, either directly to the hospital, or employee has paid and he is claiming a reimbursement from the employer. Both the things are covered in this particular provision. Expenditure should be actually incurred by the employee. In the absence of any incurrence of expenditure by the employee cannot claim any exemption under this particular provision. Technically, it is not an exemption. It is not chargeable to tax as a perquisite. Under being a proviso to section 17 subsection 2, it is not chargeable to tax under section 17(2). So, in the absence of any expenditure incurred by the employee, there is no scope for claiming this as not chargeable to tax. So, wherever the employee has incurred some expenditure for a hospital and he has claimed mediclaim insurance in respect of that. So, to the extent of the reimbursement received from medical insurance, employee cannot be said to have incurred the expenditure. For example, 1 lakh he has spent for hospital. Out of this, 80,000 rupees he has received from the medical insurance. Employer also has paid 1 lakh. Then in that context, to the extent of 80,000, employee cannot claim any exemption. Only to the extent of 20,000, which he has spent from his pocket, he would be getting an exemption under Proviso to section 17, subsection 2. Medical treatment of whom? The medical treatment can be of the employee himself or any member of the family of the employee. Family for this purpose will take the same definition as is given in under section 10, subsection 5, relating to leave travel. That is parents, brothers, sisters, spouse, and children. Now, this proviso not only covers COVID-19, the disease infection, but also all COVID-19 ailments, that is post-COVID-19 ailments like breathing problems. It can be various problems, provided a certificate from medical authority is present as a matter of evidence to say that all these problems have arisen because of COVID-19 problem. So not only COVID-19 is included, but also other diseases which is as a consequence of COVID-19 are also included in this provision. What are the conditions to be satisfied? Because as we see in this provision, there has to be there is a requirement that subject to such conditions as the central government by notification in the official gazette specify in this behalf is exempt. Is not chargeable to tax under section 17, subsection 2. So what are the notification? Notification number 90 of 2022, dated 5/8/2022, has specified that employee has to submit the following documents to the employer. Number 1, COVID-19 positive reports, all necessary documents of medical diagnosis relating to COVID-19 or illness related to COVID-19, which is suffered within 6 months from the date of being determined as COVID-19 positive. This condition is not there in the proviso, but this condition is coming from the notification prescribed by the central government. So all the illness related to COVID-19. COVID-19 is one illness, and second, all other illness related to COVID-19 should have been suffered within 6 months from the date of being determined as COVID-19 positive. This is the condition as per the board, central government notification, and a certification in respect of all expenditure incurred is required as per this notification. Subject to this notification, subject to satisfaction of the conditions of these provisions, then whatever amount received by the employee from an employer relating to medical treatment of himself or any of his family members for COVID-19 illness or any illness related to COVID-19 would not be chargeable to tax under section 17, subsection 2 as a perquisite with effect from assessment year 2021. So what happens, because this is an amendment has been done by Finance Act 2020-22 with retrospective effect on 1/4/2020. So what happens if an assessee, if the employer has deducted TDS under section 192 on these payments during assessment year 2021, 21-22? Or what happens if the employee has offered these monies received as salary income in his return of income for these 2 years, how to go about being a beneficial provision. You have to explore options under section 154 by filing a rectification application to the assessing officer, wherever the matter is. If an intimation has been issued against that intimation, you can file an appeal. After this law has come into effect, you can file a rectification application. You can also go for 263, that is revision with the commissioner, and also you can also file a continuation petition with the CBDT for getting this particular exemption, because there was an impossibility of performance because of the retrospective amendment. Assessee was not aware about the law. Assessee, therefore, there is all these options can be explored by the assessee to secure the exemption given with a retrospective effect. Now, coming to section 56.210, this is the second amendment out of total 3 amendments. We have discussed 1 amendment. Coming to the second amendment under section 56.210. 56.210 seeks to tax any sum of money received without consideration or any property received, immovable property received by an associate from a non-relative to tax under section 56.210. The proviso to section 56.210 has various exceptions on satisfaction of which the receipt is not taxable. Receipt of money, property, or immovable property is not taxable in the hands of the receiver. In that proviso, clause 12 has been added by the Finance Act 2022, again with retrospective effect from 1/4/2020. What is that? It says that this clause shall not apply to any sum of money or any property received. So the opening portion of the proviso, which says that this exemption is applicable not only for the sum of money received, but it also applicable for the property received. Property definition includes immovable property and specified assets, which can be seen. So this exemption, that is this non-chargeability, this is not an exemption, as I said earlier. If the conditions of the proviso are satisfied, then this particular receipt would not be chargeable to tax under section 56.210. One of the amendment is, if any sum of money or any property received by an individual from any person in respect of any expenditure actually incurred by him on his medical treatment or treatment of any member of his family for any illness related to COVID-19, subject to such conditions, same as the central government may specify by the official gazette. Now, this provision is similar to subclause C of clause 2 of first proviso to section 17 subsection 2, which we have discussed just now. Here also there is no maximum limit. Only difference between 2 provisions is under 17.2, amount received from employer is not chargeable to tax, whereas under section 56.210, amount received from any other person is not chargeable to tax. There is no maximum limit here also. The payer can be a relative, payer can be a non-relative, payer can be of any status, like he need not be an individual, even a company, charitable trust. Any person can pay for this purpose to an individual. The payer can be a resident and non-resident also. There is no such condition prescribed in this particular provision. Similarly, notification separate number 91 of 2022 has been prescribed, which deals with similar conditions, like you have to keep all the COVID-19 and all necessary documents and records, and all these illness related to COVID-19 should have been suffered within 6 months from COVID-19 date. The assessee has to file form number 1. There is a prescribed form in that notification giving a statement of particulars of the amount received. It has to be filed with the assessing officer within 9 months from the end of the financial year in which it is received, or within 31st December 2022, whichever is late. Now we move on to the third amendment made under section 56.210, which deals with adding one more exception, clause number 13 to the proviso, which says that again this clause shall not apply. That means 56.210 shall not apply to any sum of money or any property received. Here also both the things are included, sum of money and property, by a member of the family of a deceased person because of COVID-19, because of illness related to COVID-19. Any member of the person has died, has expired, and because of his death, the member of the family has received the sum of money or any property. From whom? It may be from any employer of the deceased person, or it may be from any other person or persons. It may be either from employer or from non-employer, from any person. So in effect, any person can give. Why this differentiation? Because wherever the money is money or property is received, wherever the money is received from an employer of a deceased person, there is no limit fixed. There is no maximum limit. Similar to 17.2 proviso, similar to the amendment which we have discussed. But wherever the money is received from any other person, to the extent that such sum in aggregate does not exceed 10 lakh rupees. So the 10 lakh rupees is applicable for any money received from all other persons other than employer of the person, wherever the cause of the death of such person is illness related to COVID-19. And what is the next condition? The payment, this 10 lakh rupees, we have to understand as in one shot or in a different installments received. Aggregate of the sum should not exceed 10 lakh rupees. Second, it has to be received within 12 months from the date of the death of the person, and subject to conditions as may be, as the central government may prescribe by the notification. Now, analyzing this provision, what does it say? It says that any sum of money or property received by a family member is not chargeable to tax. There is no limit on the sum received from employer. So any amount received by the family member of the deceased employee from employer has to be within 12 months from the date of the death of the employee. Only then it is not chargeable to tax. For any sum received from any other person in aggregate not exceeding 10 lakhs, again the condition is that within 12 months it has to be received. Sum received in excess of 10 lakhs would be taxable under section 56(2)(10). Any other person, does it include government also? Going by the literal interpretation, yes. So state government, central government paying money to any person will also be covered here. So therefore, there is a need for a clarification from the board to exclude the monies received from the government, so that being a provision for the benefit of the family members of the deceased person, government should not have taxed the same money which has been paid to them. But as literally read, the provision says that any other person, which also includes a government also. Now, there is no condition that this money, whatever is the money, 10 lakhs or without any limit, should be paid by account paycheck or should be paid through banking channels only. It can be paid in cash also, but the moment it exceeds 2 lakhs, then 269 ST restriction would apply. Therefore, up to 2 lakhs, it can be paid in cash also. Now, if you see the provision, what does it say? The limit of 10 lakhs is applicable for sum of money. Similarly, 12-month period and the conditions as per the notification is applicable only for the sum of money, not for the property received. For the property received, there are no conditions at all under section 56(2)(10). Remember the sentence of the proviso. What does it say? Provided that this clause shall not apply to any sum of money or any property received. So property received is also not chargeable to tax under these circumstances. But what are the conditions? Conditions are applicable only for sum of money, because it says from any other person or persons to the extent that such sum or aggregate of such sum does not exceed 10. So wherever property is received, one can argue that this limit of 10 lakhs, the condition or other conditions will not be applicable. So whatever is the value of the property received, that would be exempt under section 56. That would not be chargeable to tax under the provisions of section 56(2)(10). Again, the family of a deceased person may be a resident or a non-resident. There's no condition that the family of the deceased person has to be a resident in receiving, only then it becomes not chargeable to tax. So being not chargeable to tax, any person, so even if the resident is paying to a non-resident family member, then one cannot apply the TDS under section 195, read with section 918. Why? Because the receipt, it does not come under the purview of income definition at all. Section 2, subsection 24, clause 17A refers to section 56(2)(10). Because of the application of this proviso, what will happen is this particular receipt of money or sum of money or property doesn't come under the purview of section 56(2)(10). It is not chargeable to tax under section 56(2)(10). Thereby, TDS under section 195 doesn't arise, even if the sum of money or the property is paid to a non-resident family member of a deceased person. So interestingly, the definition of family here is important. The family here is not the same as relative as defined in section 56(2)(7)(a). If one were to compare the definition of family, what does it say as family in relation to? It refers to 10(5) explanation 1, which says that family means spouse, children, parents, brothers, sisters of the individual, or any of them wholly or mainly dependent on the individual. Now, if you look into the definition of relative as per 56(2)(7) explanation E, that is very vast, that is very wide in nature. Both are not comparable. But what is the exemption? The proviso is applicable only if a family member of the deceased person receives the sum of money or any property. So only these members, these people have to receive the sum of money or property. Only then they can claim exemption. They can claim that this amount of money or this property is not chargeable to tax under section 56(2)(10). If any other relative, so he is a relative under section 56(2)(7), but not a family member, he receives, for example, grandparents receiving compensation on the death of their grandchild, then there is no exemption which is applicable, because grandparents are not included in the definition of family. Vice versa, what happens if any relative giving money or property to family of the deceased person? Grandparents paying money, then what will happen? Then anyway, they would come under the definition of relative under section 56(2)(7)(a). So exemption can be claimed by the family members under 56(2)(7) first proviso, that is clause 1 of the proviso itself. They need not have to travel to clause 13 to claim non-chargeability, non-taxability, because it is a case where the money is received within the family, within the relative definition. One relative has paid to another relative. So under 56(2)(10) proviso, clause 1 of the proviso itself, the recipient can claim that the money I have received, the property I have received is not chargeable to tax. They need not have to go to clause 13 to claim the non-taxability. Thereby, the limit of 10 lakhs is also not applicable under clause 1, because under clause 1, any sum of money received from a relative is exempt without any limit. So therefore, in such circumstances, limit of 10 lakhs also is not applicable, which is very unique to clause 13 under of section 56(2)(10). Now, there is also a specific notification number 92 of 2022, dated 5/8/2022, which deals with similar conditions like maintenance of the reports, and also a statement of sum of money in Form A has to be filed by the SSC within same conditions, within 9 months from the end of the financial year or 31st December 2022, whichever is later. Effect of retrospective amendment, as I have already discussed, SSC has to explore the options under 154 or write to the CBDT under section 190. With this, we have completed the COVID-19 relief amendments. Now we will go to explanation 3 to section 37, which has been amended, which has been introduced by the Finance Act of 2022. Now, section 37 is a residuary provision, as all members would know, that any expenditure incurred, revenue expenditure, which is not a personal expenditure, which is incurred wholly and exclusively for the purpose of business, is allowable under section 37. Explanation 1 says that any expenditure which is incurred for the purpose of any offense or which is prohibited by law is not allowable as deduction. Explanation 2 says that any CSR expenditure would not be considered as deduction, would not be allowable as deduction under section 37. Now, explanation 3 has been introduced by Finance Act of 2022. What does it say? It says that, again, same expressions. For the removal of doubts, it is hereby clarified that expression expenditure incurred by an SSC for any purpose which is an offense or which is prohibited by law under explanation 1 shall include and shall be deemed to have always included the expenditure incurred by an SSC, number 1, for any purpose which is an offense under or which is prohibited by any law for the time being in force in India or outside India. Second, to provide any benefit or perquisite in whatever form to a person, whether or not carrying on a business or exercising a profession, and acceptance of such benefit or perquisite by such person is in violation of any law or rule or regulation or guideline, as the case may be, for the time being in force, governing the conduct of such person. Third, to compound an offense under any law for the time being in force in India or outside India. Like this, there are 3 components which are included in explanation 3, which we have to discuss one by one. What was the need for this amendment? It relates back to 2009, wherein the Indian Council Regulations 2000 was amended, which prohibited the medical practitioners, their professional associations, from taking any gift, travel facility, hospitality, cash or monetary grant from pharmaceutical or allied health sector industries. So the Indian Medical Council Regulations 2000 was amended with this restriction. Thereafter, CBDT Circular number 5 of 2012 dated 1/8/2012 was released to say that wherever any person has incurred the expenditure and has claimed the deduction for the expenses incurred or for the benefits provided in violation of IMC regulations, it shall not be allowable under section 37(1). Circular was challenged before the Himachal Pradesh High Court. The validity of the circular was upheld by the Himachal Pradesh High Court. Now, despite the circular number 5 of 2012, despite this IMC regulations 2000 amendment, some decisions said that these amendments are applicable from the perspective of the receiver. It is not applicable from the perspective of the payer, that is the company's pharma industry. Therefore, they would continue to get the deduction under section 37 for various benefits given. So thereby, clause 2 of explanation 3 was introduced by the Finance Act of 2020. Now, second clause 1, coming to clause 1, which said that whether in India or outside India, whether the offense can be incurred, offense is committed in India or outside India, expenditure is incurred in India or outside India. The prohibition of law can be of Indian law or a foreign law. In that context, before the amendment, two tribunal, Hamilton laboratories by the tribunal Hyderabad bench and the Bangalore bench of the ITAT in the case of Infosys said that any expenditure incurred by the SSC for visa irregularities, the amount paid to US Exchequer for visa irregularities by Infosys was held to be allowable under section 37 because the offense was of a foreign law, not of an Indian law. Similarly, coming to the third clause, which says that any compounding of offense is allowable, various decisions, the Delhi High Court had said that these compounding fees is paid to regularize the construction, which is an inherent part of the business, therefore allowable, whereas the Karnataka High Court in the case of Mamta Industries case and various other decisions have said that no, this is an expenditure incurred for the purpose of an offense. There is a compounding is an offense under the local municipal regulations, therefore not allowable under section 37. Because of the divergence of opinion, the divergence of views, the legislature stepped in and introduced explanation 3 to section 37 by the Finance Act of 2022. What does the explanatory memorandum say? It says in order to make the intention of the legislation clear and to make it free from any misinterpretation. What is offense? Not defined. Offense means commission of an act contrary to or forbidden by law. General Clauses Act defines offense as an act or omission made punishable by any law for the time being in force. Now, without the assistance of explanation 3 to section 37, the apex court, that is the Supreme Court in the case of Apex Laboratories Private Limited, said that these freebies given to doctors are not at all allowable under explanation 1 to section 37 itself. Even before the introduction of the it interpreted the provisions of explanation 1 to section 37 itself and concluded that these freebies to doctors should not be allowed as a deduction in the hands of the pharma companies. Now, when an offense is said to be committed, who will decide that offense is committed? The income tax authority cannot decide whether an offense is committed, whether an expenditure is incurred is for the purpose of committing that offense. The general rule of law under criminal law, that is presumption of innocence, is applicable. It is not an offense until it is upheld by any court or regulatory authority. Who is the authority to decide? The relevant authority and constituted under the relevant act. For example, in the context of 35(2)(ab), that is incurring of scientific research expenditure on an in-house research facility, the Karnataka High Court said that once the in-house research facility, that is the Department of Science and Technology, has certified a particular amount of deduction, then the assessing officer cannot sit over it and he cannot disallow the deduction under section 35(2)(ab). Same principles would apply here also. It's only on confirmation of the offense or prohibition by law by the relevant authority. If any expenditure is incurred by an assessee, only then it can be disallowed. There is a difference between what does explanation 3 to section 37 talk about. It says that any expenditure incurred by an assessee for any purpose which is an offense. So expenditure incurred for an offense is different from expenditure incurred in defending the allegation of an offense. There is an allegation of an offense. You want to defend it. You engage lawyer. You go to court and you incur various expenditure. That would not be covered by explanation 3 to section 37. That would be a regular business expenditure under allowable under section 37 itself. What do you mean by prohibited by law? Again, there is no definition. Each and every provision of law has to be closely scrutinized and analyzed to decide what do you mean by prohibited by law. There is a difference in terminology. The law has used the word prohibited by law. The difference between prohibited, regulated, and restricted. In customs law, we have the prohibited items, restricted items for import. So what happens if any expenditure is incurred for import of a restricted item, which is not prohibited? So one has to go closely to decide, is there any prohibition by law? Which law, which provision, which section? All those things have to be studied before coming to the conclusion that, yes, this is an expenditure incurred for the purpose of a prohibited, which is prohibited by law. Now, there are, as I said, there are 3 clauses in explanation 3. Clause 1 and 3 would refer to any law for the time being in force, whereas clause 2 doesn't restrict to any law. It also says that any law or rule or regulation or guideline, as the case may be, for the time being in force. This is the difference between 1 and 3 on the one hand and clause 2 of explanation 3 on the other hand, which is very wide in nature, which also includes not only law, which also includes rule, regulation, or guideline. How do you interpret rule, regulation, or guideline? Because the Supreme Court in the case of Apex Laboratories was interpreting medical council regulations. That regulations itself was given the status of law by the Supreme Court, and Supreme Court said that freebies given to doctors are not allowable under section 37. Article 13(3), law includes any ordinance, order, bylaw, rule, regulation, notification, custom, or usage having the force of law. Again, what do you mean by any law for the time being in force? Time being in force is understood as has been explained to be not only the law which is applicable at the time of passing the law, but also all subsequent laws. Whenever an act or omission is committed at that point of time, if it is an offense, if it is a purpose which is prohibited by law, then any law for the time being in force would get attracted, and thereby there would be a disallowance under section 37. So internal guidelines, I was explaining that I was discussing the meaning of rule, guideline, regulation, etc. How do you interpret that? Rule, guideline, regulations have to be understood in the context of law, which has a statutory backup. If it does not have a statutory backup, like internal guidelines, for example, my firm has prohibited me from accepting gifts from clients. That is an internal guideline. For instance, example. That cannot be given the statutory backup. Whatever the payer can always claim it as an exemption. The payer can always claim it as a deduction under section 37. Now, the recipient of benefit or perquisite may or may not carry on any business very specifically written in explanation 3, clause 2. Similarly, the payer or provider of benefit may not be governed by the law, rules, or regulations. That means the IMC regulations are applicable for whom? It is applicable for the doctors. It is not applicable for the pharma industry. But nevertheless, explanation 3, clause 2 would say that these pharma industry or any other industry which is giving any benefit or perquisite which is not sanctioned, which is prohibited, which is an offense or which is prohibited by law, cannot be claimed as deduction. As I was discussing, expenditure incurred for compounding of offenses, there were diverse views. Therefore, the explanation 3, clause 3 said that any expenditure incurred for compounding of an offense is also not allowable under section 37. Entire section 37 as well as explanation 3 to section 37 discusses about expenditure incurred. What about losses? We have T.A. Qureshi's case, which says that loss is different from expenditure. P.R. Singh's decision, which says that expenditure for illegal business is allowable. Legal business, illegal expenditure not allowable. Supreme Court in P.R. Singh's case said illegal business, all expenditure incurred is also illegal. It is allowable, P.R. Singh. These two decisions were analyzed in great depth by the Supreme Court recently in the case of Prakash Chandra Lunia's case, and Supreme Court said that the expenditure includes the loss. We have the Woodward Governor's case in the context of foreign exchange laws, which says that loss is also an expenditure under section 37. So Supreme Court went on to that a penalty or a confiscation is a proceeding in rem, and therefore a loss in pursuance of same is not available for deduction regardless of nature of business. Regardless of nature of business, whether you carry on a legal business, illegal business, it is not allowable as a deduction. As a penalty or confiscation cannot be said to be incidental to any business, Supreme Court has declared. Supreme Court discussed these two decisions. In the facts before the Supreme Court, there was a confiscation of unaccounted silver by customs authorities. Supreme Court said the absolute confiscation by the customs authorities, you cannot claim the unaccounted silver as a loss for the purpose of computation of business. So the same principle would apply even in the context of explanation 3 to section 37 also. The question is whether it is retrospective or prospective. Again, explanatory memorandum, notes on clauses very specifically say the amendment is applicable from 1/4/2022. Again, as I have already explained, the Supreme Court in the case of Aqua Technology said merely because you use the word for the removal of doubts, it cannot be presumed to be retrospective. Even when language is used, if it alters or changes the law as it stood earlier. So the position is it becomes prospective when it becomes prospective if it alters or changes the law as it stood earlier. So therefore, there is a view possible that amendment is not retrospective in nature, because there were decisions before the amendment to say that this so-and-so expenditure was allowable as a reduction, not hit by the explanation 1. So therefore, one can argue that with effect from assessment year 22-23 onwards, it will be applicable. Yes. With this, we have completed one more topic. Now we will move on to the next topic, that is section 43B, wherein an amendment is made by Finance Act of 2022. Section 43B, as all the members would know, that it is a deduction available only on payment basis, irrespective of the method of accounting followed by the assessee. Various expenditure which are enlisted in section 43B would get allowed only on actual payment. One of the items which are covered in section 43B is the interest expenditure, interest payable to Clause D, Clause DA and Clause E of section 43B provides deduction for interest on loans and borrowings taken from a public financial institution, state financial corporation, state industrial investment corporation, various specified categories. Now, there is an explanation 3C, 3CA and 3D to section 43B also, which says that if the outstanding interest is converted into loan or borrowing or advance, then the same shall not be considered as actually paid for section 43B. This was already available in law even before the amendment by the Finance Act of 2022. Now, Supreme Court again in Aqua Technologies interpreted these explanations and said that whenever any interest is payable, whenever any outstanding interest is payable, which is extinguished, and instead of interest payable, you issue the debentures. Issuing of debentures in lieu of outstanding interest. Supreme Court said it tantamounts to actual payment of outstanding interest. So thereby, Supreme Court said that these explanations are not at all applicable. Assessee can still claim deduction under section 43B on extinguishment of the interest liability and with a corresponding debenture being issued. Issue of debentures is discharge of interest liability as the liability to pay interest extinguishes, Supreme Court said. To overrule and nullify the above decision, specific sentence has been introduced by the Finance Act of 2022 in explanation 3, 3CA and 3D. What are these? They have introduced the words conversion of into debenture, into loan or borrowing, or debenture or any other instrument by which the liability to pay is deferred to a future date. With effect from 1/4/2023, that is applicable from assessment year 23-24 onwards. So now, because of this amendment, starting from 23-24 onwards, even if the outstanding interest liability is converted to a debenture or any other instrument by which the liability to pay is deferred to a future date, then also you will not get any deduction under section 43B. But however, section 43B, the deduction is not a permanent disallowance, because there is already a circular number 7 of 2006 which has explained with various illustrations. One has to go through that circular it says that the converted interest by whatever name called in the wake of its conversion into a loan or borrowing or advance will be eligible for deduction in the computation of income of the previous year in which converted interest is actually paid. That means what? Interest liability is converted into a debenture. You pay the debenture. The principal amount of debentures are repaid. Then in the year of repayment of principal portion of the debentures, it is in substance interest. It was earlier in interest. Now it is a debenture. So the CBDT circular itself says that nomenclature is not relevant. In substance, it is a payment of a sum of converted interest. Whenever it is actually paid, it will be allowable as a deduction. So the principles of circular number 7 of 2006 would squarely applicable even under the present scenario. Thereby, in the year of repayment of the debentures, the assessee can always claim a deduction under section 43B. Deduction is not lost permanently. Again, the amendment is applicable under what circumstances? It is applicable under a case where there is a conversion of a outstanding interest liability to a debenture, and because of which there is a deferral of the liability to pay. These two conditions have to be satisfied. If there is no conversion and deferral of liability, but altogether a extinguishment of interest liability is there with a replacement of a new liability, one can argue that despite the amendment, that explanation itself is not applicable. For example, let us say I have an outstanding interest payable. I have taken a fresh loan and paid this outstanding interest. Then these explanations won't be applicable at all. I have taken a loan, used the loan proceedings for payment of this outstanding interest. I would get a deduction under section 43B in the year of actual payment. Explanation will not apply. Delhi High Court says conversion of interest into equity shares, because in equity shares there is no liability to pay. There is no deferral of the liability at all. Equity shares are not payable except at the time of liquidation of the company. Thereby, the Delhi High Court said explanation itself is not applicable whenever interest is converted to an equity shares. Conversion of interest into preference shares, compulsory convertible preference shares. What would happen? Two views are possible. First view, explanation should not apply as preference shares are not loan or borrowing, especially CCPS. What is the terminology used in the explanation? Loan, conversion into loan or borrowing or debenture. Preference shares doesn't fall into any of this. Or the second view says that it says any other instrument, debenture or any other instrument, especially compulsory convertible preference shares. You cannot issue preference shares which are not convertible, which are not redeemable, sorry. So especially in the case of CCPS, it may fall under the ambit of any other instrument, debenture or any other instrument. Thereby, this would also get covered by the explanation. So really section 43B, we have to be mindful that section 43B overrides all other provisions of the Act, but of the Income Tax Act, but it doesn't override the Sikh Industrial Companies Act or the IBC code. It doesn't override. Especially section 238 of the IBC will override all other statutes. So because of this, so if there is a court or a tribunal which gives a direction under these special statute to say that yes, the income tax authorities are bound to give deduction for this outstanding interest liability, then that would take precedence over section 43B because of the overriding effect of the special statutes. The next provision for our discussion, which has been for which there is an amendment made, is the proviso to section 68, which is introduced by the Finance Act of 2022 with effect from 1/4/2023. Section 68 is a provision wherein if there is any sum of money which is credited in the books of account of an assessee, either as loan, borrowing, share capital, whatever it is, and if the assessee is unable to explain the source of the sum of money which has been introduced in the books, or the explanation offered by the assessee is not satisfactory to the assessing officer, then the amount credited in the books, whatever is the sum introduced in the books, can be treated as income of the assessee under section 68. Now, before this amendment, there was a proviso to section 68. first proviso to section 68, which says that in the case of a closely held companies, that is a company in which public are not substantially interested, if that company receives any share application money, share capital, share premium from any resident shareholder, it should explain two. One, it has to explain the source. It should also explain the source of the source. So there was an additional burden which was cast, which was applicable only in a case it was applicable for a specific case, that is company in which public are not substantially interested was covered. It was applicable for a share capital only, that too received from a resident shareholders. Now what they have done by the Finance Act 2022, the earlier first proviso has been pushed to third proviso and a new first proviso has been introduced. What does it say? It says that where the sum so credited consists of loan or borrowing or any such amount. So out of various categories of sums which are credited in the books of account, the first proviso, the amendment is applicable only for a sum which is credited in the nature of loan or borrowing or any such amount by whatever name called. It says that any explanation offered by such assessee shall be deemed to be not satisfactory unless the person in whose name such credit is recorded in the books of such assessee also offers an explanation about the nature and source of such sum so credited, and such explanation in the opinion of the AO aforesaid has been found to be satisfactory. What is the general rule? The onus is on the assessee to prove the source of sum which is credited in the books of account. How to discharge the onus? Identity, credit worthiness, and genuineness of transaction needs to be proved by the assessee, which has been explained in n number of decisions. These decisions have said that source of the source, that is how the creditor has paid, from which money the creditor has paid, what is his financial status, what is his financial capability, whether he has filed the return of income or not. Those are outside the control of the assessee. Therefore, the assessee need not have to prove the source of the source. Number of decisions were there which has been now overruled in the context of loan or borrowing or any such amount by whatever name called. These decisions also said that AO in such circumstances, wherever the AO feels that there is a unaccounted money which has been introduced by some other person, then the assessee should not be troubled. The assessee, the AO has to make inquiries under section 133(6) and has to catch hold of the person and proceed against him who has given the money to the person, to the assessee here, under 69 or under various other provisions, against the creditor who has lent the money. Now, there was already an existing first proviso which I explained, which was applicable for a company not being company in which public are substantially interested, which says that if the sum so credited consists of share application money, share capital, share premium by whatever name called, again it has to explain the source of the source, which is applicable, which is received from a resident shareholder. The company's obligation doesn't end by giving the name, address, PAN number of the resident shareholders. It also extends to explaining the source of the sum so credited. So what is the source of income in the hands of the shareholder? That was the first proviso. Now, the second proviso has been introduced by the Finance Act number 2022, which is applicable for any loan or borrowing or any such amount by whatever name called. Similar conditions. What are the conditions? The person in whose name such credit is recorded also offers an explanation about the nature and source, and such explanation in the opinion of the assessing officer is found to be satisfactory. So two conditions which are cumulatively, these two conditions have to be satisfied. If the assessee does not explain the source of the source, or he makes an explanation which is unbelieved by the assessing officer, then the first proviso to section 68 gets triggered, which leads to an addition under section 68. What does the explanatory memorandum says? The explanatory memorandum reads like this. It is proposed to amend the provisions of section 68 of the Act so as to provide that the nature and source of any sum, whether in the form of loan or borrowing or any other liability. Look at the difference here. The explanatory memorandum says loan or borrowing or any other liability, whereas the actual provision says loan or borrowing or any such amount by whatever name called. There is a difference here. Credited in the books of an assessee shall be treated as explained only if the source of the funds is also explained in the hands of the creditor or entry provider That means the intention is that various entry providers are only providing entries. They are converting the unaccounted money into accounted money by giving an entry. Therefore, the intention is to tax them. Intention is to catch hold of those transactions wherein the department has information about the accommodation entries. However, this additional onus of proof of satisfactorily explaining the source in the hands of the creditor would not apply if the creditor is a well-regulated entity, that is a venture capital fund, venture capital company registered with SEBI. What is the comparison between the first and the second proviso? The earlier first proviso now has become second proviso. First proviso is wider than the second proviso as it applies to all assessees and not limited to closely held companies. First proviso is applicable to all assessees, whereas second proviso is applicable only for a company in which public are not substantially interested. One difference. Second difference, first proviso applied to funds received from non-residents also, whereas second proviso is applicable only for share capital, etc., introduced by residents. This is the second difference. The status of the person who is giving the money in the form of loan or borrowing is not at all relevant under the first proviso. Third difference, first proviso applies to loan or borrowing or any such amount by whatever name called, whereas second proviso applies only to a limited point, that is share application money, share capital or share premium or any such amount by whatever name. Now, even before the introduction of this first proviso, newly introduced, the Bangalore Tribunal in one of the decisions said that it is not sufficient to say that I have received this loan through banking channels. Assessee also need to file the bank statement and the returns of the creditors to establish the credit worthiness, identity, credit worthiness. How do you prove the credit worthiness of the transaction? By giving the financial capability of the creditor. So possibly the law has taken a clue from this tribunal decision to make this amendment. First proviso, as I said, it applies to loans or borrowings even from a non-resident. The quantum of the loans and borrowings are not at all relevant. The quantum under section 269 SS and T is 20,000 for loan or borrowing. Under 269 ST, it is 2 lakhs. Whereas this particular proviso, that is the first proviso to section 68, there is no limit which is specified here. The period or tenure of loans and advances is not relevant. It may be for 1 day, it may be for 100 days, not relevant. Loans or borrowings may be secured or unsecured. Under both the circumstances, it applies. First and second proviso does not apply if the lender or investor is a venture capital fund or venture capital company. Only one exception is carved out of various things, only one exception, that is venture capital fund or venture capital company investing in the share capital. Only then these provisos, both first and second proviso, won't be applicable. It won't be applicable. For other reputed lenders like banks, NBFCs, listed companies, or even government, literally read, government is also covered without any exception. Now, explanatory memorandum refers to creditor or entry provider. So therefore, one can argue that this first proviso is applicable only if the department, that is the revenue authorities, have information about credits received from entry providers. By doing a survey, by doing a search and seize, the department gets to know about some information about entry providers. Only in that circumstances can it be invoked, or it can be invoked in all cases, is the question. Other forms of well-regulated entities are not exempted. It only explanatory memorandum says what? It says that there is a well-regulated entities like venture capital funds are kept outside the purview of first proviso. So taking clue from the explanatory memorandum, can it be argued that well-regulated entities also includes listed companies, RBI regulated banks, nationalized banks? And therefore, a loan received from these well-regulated entities are also outside the purview of first proviso to section 68. Can it be argued is one thought to discuss. There is no exemption given for loan or borrowings received through banking channels. Even though it is received through banking channels, one has to satisfy this onus under the first proviso to section 68. Now, this provision is applicable also not only from the loan borrower, it also applies for the deposit taking entities like banks, NBFCs, cooperative societies. are they required to prove the source of funds in the hands of the depositors? What do you mean by any such amount? Because the first proviso says what? It applies to any loan or borrowing or any such amount. So any such amount means any amount similar to loan or borrowing. Whereas explanatory memorandum, as I pointed out, says that any other liability which is wider than any such amount. Now, what happens in non-resident repatriating money from outside India? Is he required to explain the onus under the first proviso to section 68? There is one tribunal decision which says that non-residents income taxable under the Income Tax Act is circumscribed by section 5 subsection 2. So therefore, even if you were to apply section 68, it were to apply in the context of section 5 subsection 2. Therefore, it is an arguable case that section 68, including first proviso, may not be applicable for a non-resident borrower. Three expressions have been used in first proviso: loan, borrowing, any such amount by whatever name called. Characteristics of loan: there has to be existence of two parties, obligation to return the money with or without interest. It says loan, not debt. Every debt is not a loan, but every loan is a debt. Debt is a term wider than loan. So thereby, only loan or borrowing is included. All other forms of debts, like unpaid purchase price, capital introduced in a proprietary concern, transactions between partner and partnership firm, trade advances, share application money, various current liabilities and provisions payable to vendors, service providers, they are not treated as loans or borrowings or any such amount. Thereby, the onus under the first proviso to section 68 will not be applicable. However, if trade advances, if loan or borrowing is disguised as a trade advances, for example, the value of the services to be taken or given is only 100 rupees, for which 10,000 rupees is paid, then it is a clear case wherein a loan or borrowing is disguised as a trade advance. Therefore, first proviso would invariably applicable in such circumstances. One has to decipher the facts and circumstances of each case to decide what is a loan, what is an advance, or what can be treated as any other amount, any such amount by whatever name called. What do you mean by borrowing, which is similar to loan? A preference share capital is not a borrowing, Karnataka High Court. Bank guarantee is only a facility, but not a loan or borrowing. There is a distinction between loan and deposits. Loan means the loan borrower will go to the lender and ask for money. Whereas deposit, I have money, I will go to the bank to keep my deposit. So there is an inherent distinction between loan and deposit. Language of thereby, the language of 269 SS are differently worded. Take loan or accept a deposit. They have not used the word take loan or deposit. No. But however, deposits are also covered under the ambit of this first proviso because it used the word loan or borrowing or any such amount by whatever name called. So it has the characteristics of loan or borrowing, wherein deposits are repayable on demand or after a particular date with interest, without interest. Thereby, it is covered. What happens? So how do you apply about the applicability of first proviso to share capital, share application money, share premium received by listed entities or widely held companies? Are they required to discharge? How do they discharge the onus under the first proviso to section 68? Is a very difficult situation because exemption is only applicable for the second proviso is specifically applicable to such transactions of a closely held company with a resident investor. So there are two provisos. One, the first proviso is applicable for a share, for a loan or borrowing or any such amount, whereas second proviso is applicable specifically for a share capital transaction done by a closely held entity. If it were the intention of the legislature to cover even the share capital transactions of a widely held company, it would have simply amended the second proviso without introducing the first proviso. So thereby, one can, on a conjoint reading of on a conjoint reading of the proviso 1 and 2, one can argue that first proviso is not applicable to a share capital, share application money, or share premium received by listed entities or widely held companies, because the Discharging of honors in respect of share capital is specifically dealt by the second proviso, which is applicable only for a company in which public are not substantially interested, and that too only for a amount received from a resident investor. Applicability of the first proviso to debentures. Supreme Court said in MM Aqua Technologies that debenture is not a loan or borrowing. However, that was in the context of section 43B, not in the context of the first proviso to section 68. Thereby, we have already seen the language which says that loan or borrowing or any such amount by whatever name called, thereby it also includes debentures. Now, how do you discharge the honors under first proviso? Because you have to explain the source of the source. When the assessing officer asks about, you apply this provision, explain me the source of the source, I would promptly get back to my creditor saying that, look, assessing officer is asking this thing, please give me your bank statement, IT return and financial statements. What happens if these creditors refuse to give? Because there is only an obligation on the assessee to discharge the honors, there is no corresponding obligation on the creditors to share those documents to the borrower. Thereby, one can argue that I have done my bona fide efforts to collect these documents to prove from my end, but I have not been able to do. Therefore, there is a impossibility or impracticality of the performance. So, my honors or obligation gets discharged due to impossibility or impracticality of the obligation. One can argue on these lines. Now, proviso to section 68 is applicable for a loan or a borrowing or any such amount by whatever name called. What about deemed dividend under section 222E? First proviso will not be applicable because anyway it is taxed in the hands of the receiver. Once it is taxed, there is no question of explaining the source. In any case, even if all the ingredients of section 68 are satisfied, first proviso, assessing officer only has the discretion to make the addition because the words used in section 68 are may, not shall. Therefore, even in a case where the assessee is unable to explain, assessing officer, it is the discretionary power of the assessing officer to make an addition under section 68. We have the Supreme Court decision in the case of PK Noorjahan. Now, this particular amendment is made only with effect from 1/4/2023. Thereby, one can argue that loan or borrowing accepted prior to 1/4/2023 are not at all dealt by the first proviso. I need not have to discharge my obligation under the first proviso to section 68. With this, we have completed the portion relating to section 68. With whatever time available, we will proceed with the last topic, that is section 194R, and thereafter we will take the questions. Section 194R is a tedious provision which is introduced by the Finance Act of 2022 with effect from 1/7/2022, 1st July 2022. It is applicable for any person. It also includes a non-resident. Essentially, as a crux of the matter, 194R seeks to cast an obligation on the provider of the benefit or perquisite. Any person who is providing any benefit or perquisite is required to do TDS under section 194R. With this broad understanding, we will do a threadbare analysis of section 194R. The liability is on any person. Any person means a non-resident also. In the context of section 194J, circular 726 said that non-resident paying an advocate fees or a chartered accountant fees who is a resident of India, he may not comply with section 194J. He only had to give a quarterly statement, but that above circular is applicable only for 194J. So therefore, there is a need for a board clarification explaining what happens in a case where a non-resident gives some benefit or perquisite. Will he be covered under 194R? Or can we extend the principles of circular number 726 to those category of persons? What is the exemption given under from 194R? Exemption is given to say that the provision does not apply to individual or HUF having turnover not exceeding 1 crore in the business or 50 lakhs in the profession during the financial year immediately preceding the year in which benefit or perquisite is provided. During financial year 23-24, I am providing the benefit or perquisite to a person. So I have to look into my turnover. Am I carrying on any business or profession during the financial year 22-23? If I'm not carrying on any business, I don't have any obligation to do TDS under 194R. If I am carrying on any business or profession and my turnover is less than 1 crore or 50 lakhs during financial year 22-23, then also I am not required to do TDS under 194R, similar with the other provisions. Who is the person included here? Any person responsible for providing. Explanation 1. Explanation 1 defines person responsible for providing to mean the person who is providing such benefit or perquisite, including the company. This is in difference with section 204, which says that a payer is a person responsible for the TDS. Person responsible for making payment is different than person responsible for providing. So who is the person responsible in a case where company is providing free foreign travel to its dealers? Then it is the company which is providing the benefit, which is liable to do TDS. It may make payment to tour operator. Tour operator may arrange and send the dealers to foreign tour. Tour operator is not liable. It is only the company which is liable to do TDS under section 194R because it is the provider of the benefit. Section 194R is unique in the context that whereas some provisions, other TDS provisions makes which says that you have to deduct the TDS. Look into any TDS provision, section 192, 194J, etc., which says that assessee has to deduct the TDS, whereas the liability under section 194R is to ensure that tax has been deducted in respect of such benefit or perquisite. So in this sense, the person liable here has to ensure that tax has been deducted in respect of such benefit or perquisite. Therefore, the difference between deducting tax at source and ensuring that tax has been deducted at source prevails under section 194R. If you look into section 194B, TDS provision on winnings in lottery or crossword puzzles, it says, main provision says you have to deduct income tax thereon. First proviso says that ensure the tax has been paid. Similarly, 194S also says that VDA provision, VDA TDS provision, you have to deduct the TDS. If the amount of deduction is not sufficient to recover, then you have to ensure that tax required to be deducted has been paid. Under 194B and 194S, this ensure, the word ensure is coming in the proviso, whereas under section 194R, the word ensure is coming in the main subsection 1 itself. So there is an indication to say that ensuring that tax has been deducted at source means that the benefit or perquisite has to be paid otherwise than by cash. That is, the benefit or perquisite which is paid in money are not covered by 194R at the time of its introduction. Subsequently, law has been amended. I will come to that in a little while. Karnataka High Court said that if the winning is in wholly in kind, there cannot be any TDS. Now, what does the provision say? It says it is applicable for doing TDS on what? For doing TDS on any benefit or perquisite, whether convertible into money or not. The expression whether convertible into money or not is similar to the earlier section 28(4) before its substitution by Finance Act of 2023. So therefore, section 28(4) read with 194R at the time of its introduction with effect from 1/7/2022 till 31st March 2023 was applicable only for a benefit or only for a non-monetary benefit or perquisite. It was not applicable for monetary benefit or perquisite because of the Supreme Court decision in the case of Mahindra and Mahindra, interpreting section 28(4) before its substitution to say waiver of loan is a cash benefit or a benefit given in money, therefore not taxable under section 28(4) or under section 41(1). So for assessment year 23-24, the position of law is that only non-monetary benefit or perquisite are covered under 194R. Monetary benefit or perquisite are not covered under 194R, not covered under section 28(4). Whereas the board circular issued under circular number 12 of 2022 takes a contrary position in question number 2 to say that even monetary benefit or perquisite are well covered under section 194R. Now, as I said, the section 28 as well as section 194R both got amended by the Finance Act 2023 with effect from 1/4/2024. That is financial year, that is assessment year 24-25. which says that now the value of any benefit or perquisite in cash or money is also chargeable under section 28(4) with corresponding TDS obligation under section 194R. So the position has been changed for the financial year 23-24 relevant to assessment year 24-25, wherein the benefit or perquisite given in cash or monetary term is also taxable under 28(4), and also TDS has to be done under section 194R. Now, how to ensure that tax has been deducted in respect of such benefit or perquisite? Because the requirement of law is that ensuring, how to ensure that if the other person has a credit balance with me, then I can debit his accounts with the TDS payable, and therefore I can ensure that TDS has been deducted. Or else I have to say that, look, I am passing on a benefit or a perquisite to you. You have to pay me the TDS. You pay me the TDS, and I will pay the same to the government. Recover and pay, or pay and recover. I will pay the TDS and recover it from the person to whom I am giving the benefit of it. Or lastly, in order to escape any disallowance under section 40A, I can also pay the TDS out of pocket without recovering it from the person to whom I am providing the benefit or perquisite. Now, section 194R is applicable only if the benefit or perquisite is provided to a resident. So benefit or perquisite to a resident employee, specific provision under 192, whereas benefit or perquisite to non-resident, TDS under 195. Payment in kind, this is a benefit given in kind, whether 195 is applicable or not. We have the Supreme Court decision which says that if the value of the money is discharged in kind, TDS is applicable. Otherwise, TDS may not apply under 195. What is the limit? There is a limit of 20,000 in aggregate per resident person per year. So each person to whom I am giving the benefit, I have to look into, have I paid in excess of 20,000 during a particular previous year? If yes, then I have to comply with the provisions of section 194R. Rate of TDS 10% with no surcharge and cess. What happens if the PAN number is not furnished? As you all know, 206AA will apply, double the rates. 20% will be the TDS rate. If the other person, if the opposite person is a specified person under section 206AB who has not filed the return of income for the earlier assessment year, then double the rates. If both are applicable, higher the rates. I have to do the TDS. In the absence of any mention of section 194R in section 197 capital A, in section 197, there is no scope for filing a 15G, 15H or 197 or approaching the income tax department with the 197 certificate for a lower deduction of tax source. What is the timing of the deduction? The timing of the deduction is before providing such benefit or perquisite, you have to deduct the TDS under 194R. So at the earliest possible event, before providing the benefit, you have to deduct the TDS and pay it to the government. Now, there is a first proviso to section 194R which says that if money component of benefit or perquisite is absent, that means the benefit or perquisite is given in kind, or the money component is not sufficient to meet the TDS liability, then the person responsible for providing the benefit shall ensure that the tax has been deducted, has been paid. Ensure that the tax required to be deducted has been paid in respect of the benefit or perquisite. How to ensure that? Guideline under section 194R has been issued, that is circular 12 of 2022, wherein the deductor has to take a copy of the advance tax paid challan along with a declaration that this advance tax I have paid in respect of the benefit which you have provided to me. And that advance tax challan number has to be quoted in Form 26Q by the deductor. This is the mechanism of ensuring that tax required to be deducted has been deposited to the credit of government. Valuation of benefit or perquisite. As such, section 194R doesn't give any guidelines. Circular number 12 of 2022, which is the guideline issued under 194R, says that you have to take the fair market value of the benefit or perquisite. If the provider purchases the benefit or perquisite, before giving the purchase cost has to be taken. If some items are given by the manufacturer of those items, then the price charged to the customer for such items without including the GST has to be taken. Now, important condition is that not all benefits are liable for TDS. Only benefit or perquisite which is arising from carrying out of a business by such resident. That means the opposite party to whom I am giving the benefit or perquisite. the benefit or perquisite should arise from carrying out of a business or exercise of a profession by such resident. If he is not carrying on any business, there is no question of any doing TDS. If he is carrying on business, but I am giving the perquisite or benefit to all of them without looking into whether he is carrying on business or profession, then also TDS liability would not arise, because I am not giving specifically to them who are carrying on any business or profession. How much time more I have, sir?
Sir, we can continue, sir. Not an issue.
Okay, fine. So the requirement of TDS under section 194R is that the benefit or perquisite must be arising from carrying out of a business or profession by such resident. Meaning of arising from, that means it should sprout from carrying on of a business or profession by the other person. It should have a connection with the business or profession carried on by the resident recipient. If it does not carry on any business or profession, there is no question of doing TDS. Similarly, if benefit or perquisite is offered to any resident recipient, regardless of whether he is carrying on or business or profession, and incidentally he carries on business or profession, then also TDS would not arise under section 194R, because this is not specifically given to a person carrying on business or profession. Circular 12 of 2022 says deductor is not required to check whether the amount of benefit would be taxable under section 28(4) or 41(1). The head of income under which it is taxable is not at all a relevant criteria. You would be requiring to do TDS under 194R. For him, it may be taxable either as a business income or as income from other sources under section 56(2)(10), whatever the benefit or perquisite which he has received. Regardless of the head of income, one has to do TDS under 194R. Taxability or head of income may not be relevant. Waiver of a loan, as I said, till AY 23-24, waiver of a loan will not be liable for TDS and it will not be taxable. From assessment year 24-25 onwards, waiver of a loan is a non-monetary, even though it is a cash benefit, it is liable to be taxed under section 28(4), as well as TDS has to be done under 194R. Benefit or perquisite given to partners by a partnership firm. Whether partners carry on independent business or not is the question. If you say partners do carry a business activity of the firm, then it will be liable. Or as per Bombay High Court decision, which says that partners do not carry on, working partners do not carry on any business in doing the partnership activity. If he is doing separate business, applicable. If he is not at all doing separate business, he does only the partnership business. Then there are two views possible, because there is a difference between partner and partnership. Partnership, there is a definition under the Partnership Act to say that relation between persons who have agreed to share the profits of a business carried on by all or any of them acting for all. What happens if a retiring partner receives money or asset in excess of capital account balance, a benefit or perquisite is given? Will it be taxable? Now the position is under section 45(4) read with section 9B, the firm is taxable. So what happens to section 194R? Since the firm pays tax under 45(4), there should not be ideally any TDS required to be done under section 194R by the very same firm which is paying tax. Freebies by pharma industry to doctors, not allowable in the hands of the pharma industry because of explanation 3 to section 37, but anyway liable for TDS under section 194R. Thereby, it gives an indication that whether or not it is allowable as a reduction, you have to you have to comply with the TDS under section 194R. Interest on interest-free loans, whether it is a benefit or perquisite, has to be seriously it has to be discussed. Whether if a holding company gives an interest-free loan to a subsidiary company, then there is a, so what do you mean by benefit or a perquisite? An advantage. So by not paying interest, the subsidiary company is at an advantage. So should it deduct TDS under 194R is the question on which two views are possible. Now, there can be some strange situations wherein, in order to avoid disallowance under section 40A, the deductor may pay the TDS out of pocket. I have taken an example here. Correct me if I'm wrong. They take a case of professional fee of 5 lakh rupees is paid without TDS to a resident chartered accountant without TDS. So in order to escape the disallowance into section 40A, the deductor pays 50,000 as TDS under 194J out of his pocket without recovering. So question is whether TDS paid out of pocket without recovering, will it lead to any benefit or perquisite to the opposite party? Yes, if I had done the TDS, then he would have received only 4.5 lakhs, he would have claimed. 50,000 as TDS. Now, by not recovering the TDS, I am giving some benefit or perquisite to him. I have paid this 50,000 to the government from out of pocket. Therefore, 50,000 also can be regarded as this benefit or perquisite. It can be treated as benefit. TDS paid out of pocket by the deductor. Now, this is also a benefit. Now, on this benefit, 194R would apply. That is 10%, 5,000. If this also has to be recovered from the opposite person. If this is also not recovered, then the total benefit or perquisite to the opposite party would be 55,000. 50,000 TDS as under 194J and 5,000 TDS under 194R, both put together 55,000, which has to be grossed up as per 195 capital A, which comes to 61,111. So I have to, the total TDS to be paid under 194R would be 6,111. So total outflow, TDS outflow under two sections, 194J as well as 194R would be 56,111. In a case where TDS is paid out of pocket, see, it all depends whether the TDS paid out of pocket is given as a credit to the other person or not. If you file 26Q by mentioning this amount, by giving his PAN number, that means you are enabling the opposite party to claim a credit of this. Therefore, there is a clear benefit or perquisite given. What happens if you don't give a credit? I don't want to give credit because I have not recovered from him. If you take that position, then one can argue that, look, even though I have paid the TDS out of pocket, there is no benefit or perquisite given to the other person because I'm not including this particular amount in the 26Q. Thereby, I'm not enabling the other person to claim a credit. Guidelines under 194R2 and 3, it says that it is binding on income tax authorities and the person who is providing the benefit or perquisite. It is not binding on the recipient, who can always claim that the value adopted for 194R is in excess. Guideline says that how do you value the perquisite? By taking the fair market value, purchase cost, manufacturing cost, which is for the deductor. It is not applicable qua the person who is receiving the benefit. He can always argue that these guidelines are not binding on me, as a receiver of the benefit. It is binding on the deductor only. Therefore, while taxing under 28(4), I am entitled to take a lesser value. I can take the book value of the assets or whatever position he can take. Similarly, these guidelines are not binding on the income tax appellate tribunal, High Court and Supreme Court. Last point, specific examples dealt in circular number 12 of 2022. The question number 3 deals with perquisite or benefit in the form of capital asset. Also, TDS has to apply. Sales discount, cash discount, rebates allowed to customers, offering free items with purchase of another items. Even though there is a benefit, in order to remove the difficulty, the circular 12 of 2022 has said that there is no requirement to do TDS under section 194R on these particular benefits. Free samples, incentives, sponsoring a trip, free tickets, TDS should apply as per the circular. Benefit availed by employees of recipient entity, TDS has to be made on the recipient entity. Recipient entity will in turn do the TDS under section 192 for passing on the benefit to the employees. This is the manner of discharge of TDS obligation dealt under question number 4 of circular 12 of 2022. Similarly, the case hospital receiving the benefit, either if the doctors are working as employees, the person providing the benefit will do the TDS on the hospital. Hospital will in turn do the TDS under 192. If the doctors are working as consultants, then what will happen? The person providing the benefit will do the TDS on hospital under 194R. Hospital will again do the TDS under 194R on the consultant doctors who are carrying on profession. Specific exception for 194R does not apply to benefit provided to a government entity like government hospital not carrying on with business or profession. Social media influencer using a product and returning it back, TDS not applicable. He is returning the product with him, TDS should apply as per question number 6. Very interesting, reimbursement of out-of-pocket expenses. We all bill out-of-pocket expenses to the clients. What is the 194R position on this? Question number 7 says that if these expenses are incurred and the invoice are taken in the name of the client, no TDS. On the other hand, if I incur expenses, invoices are in my name, I recover it from the client. Client has to do TDS under 194 or on this out-of-pocket expenses. But practically, as you all know, the client would do the TDS under 194J on both professional fees as well as on the out-of-pocket expenses. Dealer conference to educate dealers about the products of the company, no requirement to do TDS. However, in order to, if you conduct the conference in Goa in a posh 5-star hotel, you arrange air travel tickets and hotel stay for the dealers, then to that extent there would be TDS as per question number 8. limit of 20,000 has to be reckoned from 1/4/2022 and not from 1/7/2022 as per question number as per question number 10. Similarly, the position with 194Q also, purchase of the TDS on purchase of goods, same principle is applicable. You have to see the limit of 20,000 starting from 1/4/2022 onwards. With this, I have completed the discussion on only few select topics. I have not discussed the entire amendments relating to tax audit for assessment year 23-24. I thank the KSCAA once again for giving me this opportunity. I am happy to address any questions by the members.
So we have a couple of questions on the chat box. Loans and advances given to related party written off, will 194R be applicable?
Loans and advances given to related parties.
Written off.
Okay.
Would 194R be applicable? So
for the other person who has taken the loans and advances and I have given the loans and advances and have written, I am not recovering it back.
Correct.
It should be applicable, provided he carries on any business or profession. If he is not carrying on any business or profession, then there is no TDS. Because with effect from 23 financial year 23-24 onwards, the waiver of a loan is a cash benefit as held by the Supreme Court in Mahindra and Mahindra. So if this transaction has happened during 22-23, I would say not liable for taxation under 28(4), not liable for TDS. If this transaction were going to take place in financial year 23 onwards, then clearly 28(4) as well as 194R both would apply. 28(4) provided he carries on any business or profession.
For bad debts written off, would 194R trigger?
Bad debts. I have made a transaction. I have made a sale, and I have to receive the money from the opposite person. So he is carrying on in case same this thing, same principles. It will be taxable from financial year 23-24 onwards.
Would 194R be applicable for employees?
194R, no. 192 is a specific provision. Because the requirement of 194R is the opposite person has to be carrying on in a business or profession.
Cash introduced by partner within 2 lakhs number of times, whether section 269 ST is applicable.
Within 2 lakhs, right?
Yes, but on multiple.
ST incidentally makes there are 3 expressions in 269 ST. In transaction, event, or occasion, 3 different terminologies are used. So going by transaction level, each transaction is different. Therefore, cash introduced a number of times, 269 ST should not be applicable. When it comes to event or occasion, see, introducing cash to a partnership firm is not an event or any occasion. This is not an event like marriage event or any other ceremony, etc. If you incur many number of expenditure under that particular umbrella of event or occasion, then 269 ST would apply. Otherwise, no.
I think that's all we have, sir, in the query box. Yes, sir. So I take this opportunity to extend a formal vote of thanks to our speaker. On behalf of KSCAA and all the attendees, sir, we thank you very much for your detailed and insightful discussions. Thank you for having consented for our program and having devoted your valuable time.
Thank you. Thank you very much. I once again thank the participants for giving me a patient hearing and for listening this conference. Thank you very much.
We meet again tomorrow at the same time to update ourselves on recent judicial pronouncements impacting our tax audits for the year. Thank you. Thank you all. The session for today stands concluded. Thank you.
Thank you so much.